I never expect intelligent decision making.
I know it's hard to believe. Like, I honestly, again, if you go back in time when you started increasing interest rates so much, that would have been a perfect time to actually include this, where it kind of offsets the high interest rates, is saying, hey, here's a 30-year amortization. I'm just saying now, coupled with the effect of interest rates now dropping for the first time when we've had a long time significantly, now coupled with inflation
now
numbers
you're going to juice the prices.
Right now,
it's like, why would you do that all at once?
Exactly. Everybody's saying October is going to be a 50 basis point cut. So now you're doing that plus the amortization plus everything else. Like, it's going to be a very interesting Q4 for the rest of this year.
Welcome back to REI Hot Seat. Andrew Hines here with Zac Wilms, and we did have the other two guys here, but they both had to leave. So this would have been a great panel discussion, but what we're going to be doing now is we're talking about the recent market changes. So much has happened in the last week. We had the Fed announcement dropping 50 basis points. We had the Canadian inflation numbers come out at 2%. We had the announcement that now CMHC is going to insure mortgages up to $1.5 million and will allow 30-year amortizations on new construction homes, which already was a thing, and any first-time home buyer. So now what we're talking is you can come into the country, get your residency, go buy a house, and drive up the housing costs. I got so many opinions on all this stuff. We're going to get into it. So anyway, Zac, first off, thanks for doing this.
Thanks, Andrew. Yeah, always happy to be here, guys, and talk about the market. And we got a building as well, too, that we got a building.
So yeah, this is a jam-packed episode. So we're going to do market first. The building will be a quicker one. It's a good one. It's pretty straightforward. It's boring real estate, which we like.
It's my favorite. Boring real estate. It's a 40-unit building in Kitchener. It's off market. So we're going to talk about that at the end. But first, let's cover the market. Like, what do you think of all these changes?
It's like overload all at once,
It is.
Right?
There's a lot.
I mean, first off, like, no matter what, like, debt drives real estate prices. Debt drives everything. If debt was not a possibility, a house would still cost what somebody could reasonably save in a year or two. It's because we allow for debt that politicians spend money they don't have. People do the same thing. So the more we allow, like, say CMHC is now going to allow 35-year AMs, that effectively
just
30. So 30, that effectively that extends buying power, right? Because now your debt service is lower because your mortgage payments are lower.
But it increases the amount of interest you pay over time.
Yes.
Right? That's the other side of the coin. So it's like, great, you can get into this property, but you're going to be paying more interest over the long term.
Well, but this is the unintended, I agree with you. This is the unintended consequences thing, because obviously the policy program was designed, with it, I would assume they designed it so that more people could afford to buy a home.
For sure.
Right? Because you're looking in GTA, 1.5 million, it's like a shack. So if you want to buy that house and get your 95% or your sliding scale CMHC financing, now they'll actually insure that up to this point that, once you're past $1 million, like, what do all the people with $1 million to $1.5 million properties do? They couldn't get CMHC insurance.
No, they had to put down 20%.
They had to put down 20%.
So think about that. You're putting down $200,000 on any property over $1 million.
So now I'm assuming there's been a huge spike in interest in any property that was listed in that range. 1.1, 1.2, 1.3. Now all of a sudden newfound interest for those properties.
It doesn't come into effect until December 15th.
Right, so they'll be scheduling long closings.
Well, exactly, right? That's the caveat. I already had somebody ask me this today. They're like, well, Zac, can we go buy a property today? I'm like, well, it's not even December 15th, because think about it. You're going to have to be like in January, because your mortgage broker is going to have to actually start these new rules after December 15th.
Oh, okay, so they won't even be able to apply until December 15th.
As far as I know. Again, this just came out, so that could be wrong.
But and a lot of times, like with this news stuff, guys, like we don't have all the details. Like we share what we know, and sometimes we're wrong about stuff, but we're not lying. We're just telling you what we know.
And just the different side of the coins too, right? Because I've heard everybody talk about this. Well, 30 amortizations mean you pay more interest over time. But I'm like, if you're a first-time home buyer, are you really staying in there for the whole 30 years? No. You're probably in and out in 5 years, sometimes less, sometimes a little bit more.
No one's ever paying off their home.
So I'd love to see,
no one, but very, very few.
I'd love to see just the interest differential between you getting a 25-year amortization and a 30, what that looks like only on a 5-year outlook. Not the whole 30, because obviously if you do the whole 30, yes, there's a way bigger outlook. But on 5 years, how much of a difference is that?
How much extra interest are you paying?
Because no first-time home buyer is buying a home in Canada and staying there for 30 years. Your family's going to grow. You're going to want to move. Maybe a job happens.
Especially if you're first time.
First time.
You're absolutely right. So, of course, though, even in a 5-year span, you're spending more on interest. You're paying down less. No question. I think of debt as something people get drunk on, and this allows us to get a little drunker on debt.
Yep.
If we're calling a spade, what will it do? It's going to put a lot more money in the sellers' pockets that are selling properties in those ranges, which to them is a benefit, right? They're going to be able to go on and buy their next home,
for sure,
what have you. So, but does it create more housing? No. In a supply and demand equation, you have supply and demand. They just can't address supply, so they keep messing with demand, and effectively this lever affects demand. It increases demand for real estate, which will drive up the price.
For sure.
So unintended consequence, what it's going to do is it's going to make real estate more expensive, which, some people will love, no problem. I mean, it is what it is. That's just my take on it. So that's one part.
But the government's doing it on purpose, right? So they're allowing these 30-year amortizations and doing this on purpose to allow housing prices to increase, which is interesting because I feel like in the past, they've always tried to reduce housing pricing. Right, like when they see it start running away, they try to scale it back, and now it's
you're saying they've expressed that as they want to increase the housing prices.
No, but I think anybody with a brain knows that you doing this.
Hang on, you can't use your brain.
I know. Just you thinking about this logically, you would say that, hey, we're implementing these changes at the same time as interest rates are coming down. Like you guys are setting up a catastrophic bomb to go off in real estate, which is what they've been trying to avoid for so long. That just leaves me scratching my head. Like, what is the outcome of this?
I don't expect politicians and bureaucrats to exercise common sense. And like you're explaining absolute common sense. Like any of us could sit here and say, well, if you make it so that more money is available to buy that specific real estate, the price of that real estate will go up.
Yeah.
Like that's obvious. Don't even get me started. Anyone who's followed my podcast knows how many completely obvious, basic deductive reasoning things I've called out over the years and been right about. You just can't expect that of them.
I know.
Like I saw that.
Expect the unexpected.
Did you see the video of Jagmeet getting called out and like getting in people's faces?
No, I don't think I did.
So I just did a review video on my Instagram of this, but Jagmeet Singh got called like corrupt by some guy, and then when he confronted the guy said, "It wasn't me. It wasn't me. It must have been the guy behind me." And that's not the point of this, but like I get the impression that guys like Jagmeet and Trudeau actually believe the things they say. Like they're just kind of useful idiots.
Yeah.
If I'm being blunt, like I think that they're put into that position because they don't overthink things, because they can be the pretty face or the nice voice and say the things that people want to hear. So they find people that will say things that just do not work. For instance, like this program, ultimately the finance minister in now is a result of the Liberal government, right? They choose them. So these houses are a result of that government. They happen because of it. So anyways, I just thought I'd share that. I never expect intelligent decision making.
I know. It's hard to believe. Like I honestly, again, if you go back in time, when you started increasing interest rates so much, that would have been a perfect time to actually include this, where it kind of offsets the high interest rates, is saying, hey, here's a 30-year amortization. I'm just saying now, coupled with the effect of interest rates now dropping for the first time, and we've had a long time significantly, now coupled with inflation
now you're going to juice the prices.
Right now,
it's like, why would you do that all at once?
Exactly. Everybody's saying October is going to be 50 basis point cut. So now you're doing that plus the amortization plus everything else. Like it's going to be a very interesting Q4 for the rest of this year.
It's going to be a wild ride.
Yep.
It's going to help a lot of people out who've been needing, like now sentiment changes, right? Like, are we at 3? We're at 3 drops now, right?
3 drops with another big one coming, and the bond rates are dropping drastically, which in our commercial world is more impactful for our clients, more impactful for what we do on a day-to-day basis than the interest rates really are. So now with bond rates also coming down, it's just helping all of our clients.
Yeah, bond rates were I did a little video on this not too long ago. They were down like 2.7 for a 5-year from its high of 4.3 like a year and a bit ago. Like it's a significant drop. And I put this out there because I know the official explanation, or one of the official explanations for why our bond rate and the overnight rate, which was lowered, connected and correlated. And the response, like the textbook response, is that, well, when the overnight rate is dropped, it signals economic worry. So then more buyers flock to bonds and they drive the price of bonds up, therefore driving down the yield relative to the price you paid. So that's the economic professional explanation. I think there's more to it than that. I was kind of fishing, but nobody ever, gave me any bites on that.
Probably more than we don't know.
Yeah, there's a lot. Like how are they so directly linked? I mean, I would attribute part of it to like if overnight rate drops, now you've got more money available to you. You have more money to put into bonds. So that, there's going to be a lot of smaller market effects and then the major market effects, which of course like market sentiment. But I just don't get it. Like when people say, hey, we expect them to lower rates, and then they do, nobody's surprised. Like at least not in this case.
One thing I will say about the new changes about allowing it for pre-construction and new homes, I think that actually is a smart move because there's been such a stall in those projects. So if those projects get stalled, that means there's no more new supply coming on. And remember, this supply is not coming next year. This supply is coming 3, 4, 5, 6, 7 years down the road. So if we stop that now, that cascade of a problem is going to be 7 years from now. It's not going to be right now. We're not going to feel it. So I think that part of the pie was a very smart move because we do need to re-engage.
And they did that a while ago, right?
Like they did that with the new homes. I think
new homes, but you said it didn't include condos.
I believe it didn't include condos. And now that it does include condos have been taking the biggest hit over the last little while in terms of sentiment and buyers and investors. So I think we do need to get those projects back in the pipeline because them being stalled for too long is no good for anybody.
There's a ton that they've been doing, like the Canadian government's been doing over the last year to really try and stimulate housing building, like new units built, not for homes, like for like home ownership, but even with the MLI program and the things they're doing. When that program was starting to stall, they changed things to just entice people to build more because otherwise nobody would be building right now.
I know.
And they just need housing so bad. So I can absolutely see there's a lot that they're doing to try and stimulate it. Reasonably, they're going to keep doing that because Canada's also drunk on immigration because we need to replace the aging population. We cannot have all the boomers retire and then have no population to support them. So that's why. It's because the boomers didn't have enough kids and we don't have the millennials having enough kids that, look, we're going to have to keep immigrating. That's really what it comes down to. So Canada's drunk on that. And we need to keep that attractive for them because you'll hear Indian people come here and they'll say, oh, it's not what we thought it was. Like they're actually disappointed. So the sentiment has changed a bit and Canada's going to need to do some things to get that back on track to keep people wanting to come here.
Yeah, have to.
They're drunk on it.
They're drunk on it.
One final thing is that, yes, the CPI was at 2%. Just before we jump into this, CPI was at 2%. I was reading an article that finally called this out, and I always thought this was so absurd. In CPI, you have housing costs, which includes interest. So when the government increases interest rates to fight inflation, they actually directly drive CPI up. So a lot of what you're seeing now is the 3 rate decreases now panning out into the CPI. We're seeing it drop to 2. 2 is like target rate. And then, of course, it's been falling. So this is where the economists don't want us to go into deflation. So that they're going to, big reason just why the sentiment is and that people think we're going to keep seeing rate drops is that because it's been falling and falling. And that's despite them dropping interest rates.
Yeah, having interest as part of that basket just never mid any sense.
Beyond dumb. But again, common sense.
I know. There you go. That's the common theme of this episode is common sense. When you think something makes sense, just if it comes to the government and how they do things with economics, it doesn't make sense.
Right, exactly. It's like so dumb that if you look at it, you're like, wait, really? It can't be.
Yeah. No, it is. No, it is.
It is. But that's why you come to shows like this to hear the truth because politicians don't say it.
We're boots on the ground, right? We're looking at this every day. It directly affects what we do in our business, what we invest in, how we look at the market. And when you're looking at it from an objective standpoint, it just doesn't make a lot of sense. And it's frustrating from a grand scheme of things.
Right. But I mean, I think I always look at this stuff is like, how can I use this? Like, I want to know what's real, what's true, and I want to be able to use that for my success, for my family's betterment, all that. So I think that really is the theme of 90% of the content, 98% of the content I put out, and I want to stay that way. So let's transition into, buying a building. A lot of reason, all this stuff we just said, inflation seems to be in the cards. Wouldn't it be a great idea to own more fixed assets?
For sure. Exactly.
Good segue. Let's talk about a 40-unit building.
Yeah, so this is a 40-unit building. It's in Kitchener. It's in a good area. It's off-market, so we can't share the address with you at this point. So I just want to do a quick high-level overview of how the numbers look. This is the spreadsheet that we use as kind of the quick snapshot where you can easily just look at this and see if it's going to pan out.
Using CMHC standards, all right?
Correct.
So this is CMHC guidelines for underwriting, which we always use on this show just to keep things consistent. I shouldn't say always, but most of the time that's what you're seeing.
Correct. Yeah, this is the best way to underwrite deals, right? Because this is the best financing you're going to get out there in the market. So very simply on the right-hand side, we got our income coming in, we got our rent, our laundry, and our parking. They even had a little other income as well too that they're getting. I don't know exactly where that's coming from, but we can verify that. Vacancy is very low in Kitchener. CMHC has it at 1.6%. like extremely low on these types of buildings. When you come down to the expenses, really the only thing we use here from the actual building owners themselves is the taxes and the utilities. All these other numbers here you see, these are all CMHC standard numbers.
Okay.
So what we'll do is we'll verify these numbers based off what the building has told us. If the building actually says that their insurance is higher, we'll use that number. But most of the time, they're telling me like for insurance, their insurance might be $23,000. But I'm using CMHC standard numbers because that's how they're going to underwrite it anyways.
So it needs to work at the CMHC number, so you'll use that. So just as an owner, you might be pleasantly surprised.
Yeah, exactly. You might go get a quote and it might be $23,000, right? So you might actually make these numbers look even better. But it's always best to look at this building from CMHC standpoint.
Would CMHC adjust their number if you showed them a quote for less?
They probably would. But at the end of the day, it's always best to look at it from this standpoint first, and then we can dive deeper after that.
Yeah. Okay.
So high level, you're buying this building for $9.4 million. Price per unit's $235,000. It's sitting at a 5.4% cap rate as is right now. 85% loan to value, 40 amortization, and we're using an interest rate at 3.43, which is confirmed by somebody on my team. They just got this rate yesterday. That's why I wanted to put it in here. This is the latest and greatest rate that you're going to get from CMHC right now.
Would that be a 5-year rate?
That was, I believe it was a 5-year rate, and our debt coverage ratio is 1.4, so you are good to go on a 5-year rate.
And would you? I mean, I would, if I could get that locked in at a 10, I'd be interested.
Yeah, some people want to.
Yeah, I mean, absolutely, because no one knows what the next 10 years bring, right? I like the U.S. style where they go 30 years, they get the full thing.
It's just something like this. This is what I call boring real estate, right? This is a simple 40-unit building. There's no cash for keys that you need to do. There's no big value adds you need to do. You're basically coming over here. You're putting in your $1.6 million, and you're getting a 9% cash on cash return.
9%. Yeah, that's great. I mean, the cash flow was how much was it? It was like $11,000 a month.
Yeah, you're almost $12,000 a month in cash flow. And again, remember, guys, that's including $28,000 for on-site salaries and caretaker, and including an additional $32,000 for a manager. Yeah,
so there's a lot of money being allocated, so you don't have to run it. So if this is in the cards for you, if you got the down payment, because that's really the question. What is it going to take to get into this deal? Yeah, that's really what it comes down to. So I have it right now at $1.6 million to get into it. Again, that's a 1% lender, 1% broker fee. There may be some flexibility there. I got property reports in there. That's going to be your ESA, your building condition report, and your appraisal as well. So you're coming in about $1.6 million. That seems pretty actually reasonable. Right? For a 40-unit building, turnkey, you just buy this and hold on to it for the long term. Obviously, this is purpose-built. It's going to be a brick building. Exactly. It's going to be something that's probably been very well maintained and managed over time. Yeah, these are assets that can either be the foundation for your portfolio or just a great addition that you're probably likely never going to sell. Maybe you pass on to your kids. Like if it was me and I bought this building, I would have no plans to sell it. So I probably would put the 10-year on it with the rates that we have today and then just hold on to it. Slowly turn units over as they come. But for the most part, just own and operate this good asset. Yeah, $11,000 in positive monthly cash flow is certainly it's a good buffer, right? I think a lot of things could change and you're still well in the positive. Yeah, exactly. And even if you look over on this side too, you got $100,000 a year you're paying down in principal and $141,000 you're making in cash flow. I like it. Whether the building appreciates or not, those are pretty good numbers. Love it. All right, Zach. So is this something people can move on? This is something that is active right now. It's off market, but it is something you can reach out to us and we are happy to go through all the numbers, share the address, and have a full conversation about it. Cool. All right. So on that note, if you've been following along, guys, please make sure you show the channel some love. If you're a podcast listener, rate and review us. 5 stars would be greatly appreciated. Helps the show grow. And make sure you're on the insiders list. So that link is in the show notes or in the description of this video. That allows you to get onto the mailing list for the team here. So the real estate team, that's really the cast of this show. Outside of me, I'm not a realtor. But they're the cast of this show, and they do their deals of the week. So these guys, Zach, Jake, Dave, always have like really cool deals that they're aware of because of what they do, because they're focused on this stuff. And that gets you access. And other things too. I think there's an outreach call and you get to talk to people on the team. Yeah, exactly. It's just your way to get access to these deals as soon as they come out, right? That deals of the week is really where we put the latest and greatest deals as soon as we get them sent to us. Yeah. So very cool. All right, guys. Thanks a lot for this. Thanks, Zach. Thanks, guys. And we'll see everyone next week. Take care.